Hi there, welcome to Grain TV. It's Thursday, March 10th. We had an up day in grains. Let's take a look at the Grain Edge trading platform and see where we closed. In Chicago, corn was up 3 1/4, beans up 3 1/2, and wheat a leader to the upside, gaining 8 3/4. News today, we had export sales out this morning. We'll get to those in a minute. They were pretty supportive in the case of corn and a little bit supportive in the case of wheat. The real news, though, continues to be the dry weather problems that are starting to materialize in the plains. The 7 to 10 day outlook doesn't look any better for that Oklahoma, Kansas region that is starting to creep into a drought condition. So it's still early in the season, but as we get into the growing season that'll really start to take shape in April, we're off to sort of a sort of pessimistic start in terms of crop conditions, and the outlook for at least the next few weeks is for more dry weather for that key Oklahoma and Kansas growing region. Other news out today, the European Central Bank came hard into the market with stimulus in terms of lowering interest rates and reducing deposits on demand. So the end result was a big drop in the US dollar, off 1.2% as of this taping, and that is exceptionally supportive for grain. We'll talk about that also here in a minute. But let's turn our attention now to the weekly export sales that came out this morning from USDA. Now keep in mind that on Wednesday in their USDA WASDE report, they did not change their corn exports or their wheat exports, and both of those categories have been trailing sort of forecasts needed to reach the current pace. So we got to really keep our attention on corn and wheat to see if we're going to see any sort of uptick. This week we saw really favorable numbers for corn, 1.1 million metric tons combined for old crop, new crop. That was just at the high end of the range of estimates, with 800,000 to 1.2 million metric tons being the range of estimates. On wheat came in at 433,000 metric tons, again coming in at the high end of expectations, and beans coming in on the low end of expectations at 478,000. Let's take a look at our scorecard and where we stand relative to what USDA is projecting based on cumulative commitments for all three crops. And what we see in all three cases is we are behind the pace of last year to reach USDA's target. So for example, in corn, USDA has a target for this year that is 12% below last year for their annual export forecast. We are trailing that mark by 20%, and in the case of wheat, we're trailing last year's pace by 18%. USDA is looking for a 9% drop. So that is disappointing and makes you sort of question whether we can get a rally out of this market with those disappointing export numbers. But what is changing is really the stance of the US dollar in the global marketplace. And part of that we started to see in the last few months, but I think today was yet another indication that this bull market in the US dollar is potentially coming to an end. Let's take a look at a real long-term chart. This goes all the way back to the recession of 2008, the US dollar index trading here. And what you can see, particularly 2015, the start of 2015, when we really started to march higher, and that US dollar has just been exceptionally high. Over that period, about a 20% increase in the US dollar relative to other currencies. That makes our grain 20% more expensive than it was before 2015. So you think about the timing of this, it couldn't happen at a worse time when we're starting to see increases in stockpiles, not only in the US but abroad. And so we are at a competitive disadvantage. On Grain TV, we continue to talk about how disadvantaged we are in the global marketplace, but those conditions may be changing. Let's take a look at a shorter term trade here on the US dollar index dating back to the harvest of October. And what you can see basically is sometime in November, when the European Central Bank first came out with their negative interest rate policy and tried to stimulate their economy, that led to a big drop in the dollar. And what we're starting to see is sort of what I call elevator down and escalator up. So we're seeing big drops down and then slow and flatlined or slightly increased recoveries up, followed by more steep declines and escalator up. So yet again, today we had a 2% change in the value from high to low in the US dollar. Big swing, but I think overall what we're setting the stage for here is a return to the lows we saw back in October. Keep in mind, that's when we were harvesting our corn and bean crop here. And so for the entire post-harvest season, we have seen the US dollar at exceptionally strong values. And I think in the next 6 months, that is going to change markedly in the favor of U.S. commodity prices and hopefully improve our export situation. If you have any questions or want guidance on your own grain marketing situation, by all means, give us a call, 877-472-4607, or visit us online at grainhedge.com. Silver right now is at historically low levels. Starting with the financial crisis of '08, silver prices made an epic run from $10 an ounce to $50 an ounce in just 3 years. Silver looks poised to make another run higher. Here's why. Today's headlines show wide-scale economic risk, central banks using negative interest rates to stimulate economic growth, and the continued explosion of government debt around the world. All these factors are creating a flight to safety in physical metals. On the fundamental side, high mining costs limits new silver supplies, while demand for silver continues to expand through rapid use in cell phones, plasma TVs, and batteries. All these factors suggest taking action at today's prices before silver reaches $25 an ounce. Our precious metals desk at GrainHedge can educate you about investing in physical metals. Their goal is to put the most amount of silver and gold in your hands at the least cost. To get started, contact Rodney at grainhedge.com or by phone at 877-472-4607.